Right, hello everybody. Welcome to today's vodcast. It is the 6th of March 2023. My name is Adrian Buthee. I'm one of the directors of Trendsignal, and today I'm joined with our managing director, Jerry Miller. Hi, Jerry.
Yes, hello. Hi, all.
So what are we doing? Jerry, we're going to do a bit of a review of the markets over the last week or so. So if you wouldn't mind just sharing us a little bit of insight into what we know, what's happened last week, what did the markets do, and so on.
Yeah, an interesting week, certainly for markets, especially on Friday. Just an unusual move generally. With if you want to put up the S&P 500, that might be helpful as I speak, Adrian. But equities rising, bond yields falling in what looks like quite a good risk-on rally. And when we talk about a risk-on rally, we're talking about equities going up, bonds. Well, typically bonds should go down, but bonds were going up, the dollar going down, and commodities going up. And you think, well, that's fine. What's wrong with that? But when you look at the data coming out, Adrian, there was some very odd moves or odd releases, to the extent that we had some very strong data earlier on in the week. I think it was what was it? I think it was the core retail sales, durable goods. I said core durable goods. So core durable goods, as a strongish data release. It's core because what they do is they remove some of the transportation items, which can be a bit sort of volatile. You know, if an airline, foreign airline buys sort of 50 Boeing 787s, it really distorts the data. So they remove them. But the actual data came in stronger than expected. You think, well, okay, that's one bit of data, but this follows hot on the heels of the strong PCE data the other day. That's the personal consumption expenditure, which is the Fed's measure of inflation. It comes on the hot on the heels also of the non-farm payroll. I know we've got it this week again, but 4 weeks ago, Adrian, we had an astonishing release. So it looks like this data continues to come out on the strong side, suggesting that the economy, the US economy, is pretty robust. And yet the market rallies Friday, normally with the expectation that the Federal Reserve is going to be raising rates more than expected, or not concluding its tightening cycle. You'd expect equities to come off. They didn't. They rallied. And part of the reason is you don't need to look anywhere else apart from at the bond markets. So if you can actually put up the FT page with, okay, so this is quite a handy little tool. This is what this chart is of the yield for the different duration of bonds. So the one we're interested, Adrian, if you could put your cursor over the 10-year, just leave it. Yeah, that's fine. That's fine. So we've got three lines here on this graph. One, the brown line tells us what the yield on the 10-year US Treasury was a month ago. And what I mean by the yield, that's what investors will get from holding those bonds on an annual basis for 10 years. 3.66%, a lot better than it used to be. But throughout the month, yields have been rising sharply. Now, this contrasts with what happened in January, where yields fell sharply as the market felt very optimistic that inflation was tamed. It was core inflation wasn't sticky and all this sort of stuff. But you can see now, if you looking at it, a week ago it was 3.96. So, gosh, a month ago 3.66, 3.96. So yields have jumped really sharply, and that's what's causing the market's problem. A big problem, certainly over the last 4 weeks, as investors have come to realize that the Federal Reserve is going to be raising rates further. We'll get onto that FedWatch tool in a second, but let me just conclude this bit. Whereas on Friday, there was a bit of a snap back. Yield on the 10-year went up to around 4%, but then suddenly fell. It's good old-fashioned profit taking, really, Adrian. That's the main explanation. There are rumors of slightly a revision to the non-farm payroll data from about 4 weeks ago. But I think this is just people taking profits. It's the new month, the third business day of the new month. And I just think it coincided with a bit of a thinner market at the end of the week, and bang, all of a sudden yields come falling down. And equity traders look at it and think, right, I'll buy the stock market. So it's not something that I don't think it's got legs, not on its own anyway.
Well, it was interesting when I was looking at the VIX market last week, which is often a good measure of where the market might be sort of at its sort of natural extremes. And to the downside, it seems like there could be a bit of a way to go yet. It's certainly not massively fearful at this stage, was my conclusion. So it was definitely an interesting rally. Jerry, can I just quickly ask, just to recap, you've mentioned the phrase "risk on" once or twice. What does that actually mean, just for those that may not be so sure?
Risk on, it's where investors put their money into riskier assets. And just to be very clear, equities are regarded as riskier assets. If you want to keep your money safe, you put it into sovereign bonds or UK gilts or treasuries, that's US sovereign bonds, or you keep it on deposit at the bank. Then you've got no risk at all. But when investors are happy with the stock market and they pile in, that's what's called a risk-on move, where they're buying equities. When they're selling the dollar, they're putting their money to work in other jurisdictions in emerging markets, and where they're buying commodities.
So it has a similar effect on, well, it has an effect on currencies as well, because obviously there are certain riskier currencies, you could argue, than others, right? So which would those be, for example? So you mentioned the dollar might fall. What others might fall? What might rise?
Well, that's interesting. It's mostly because normally the dollar is a sort of a lightning rod for how can I say, safe haven. So that's where people put their money when things are looking a bit questionable. But when the markets are more convinced with a risk-on rally that happens, the dollar tends to suffer because investors start moving their money into riskier assets and risky emerging markets. And I'm talking about developing economies, not developed economies. There's an ED and an ING different here, but the developed economies are obviously the ones that we know in the West, but the developing economies, the ones in the Far East, in Latin America, those economies have been suffering with a strong dollar, but when the dollar weakens, they benefit from it. I think it's a short-term thing, this though, Adrian.
Yeah. Okay, so well, you can certainly see. I mean, last week, the S&Ps, the US sort of broad sort of 500 stocks, biggest 500 stocks by market capitalization. That was a decent move in the end. I mean, a lot of it was from Friday, of course, up about 2% there. Bit more on the Hang Seng, there wasn't it, Jerry? That was certainly a bit stronger.
Yeah, the Hang Seng did particularly well. I mean, it's very much tied to China, obviously. Japan's done well because of the weak yen. If you look at the Japanese yen, you can see that the Japanese yen has been falling quite sharply for the last month or so. And the reason being there is that the Japanese they've got a new central bank governor coming in. This chap Kuroda, the incumbent one, has been replaced by a new guy called Kazuo Ueda, and his tenure starts on the 8th of April. So, yeah, the yen basically has fallen because some investors thought perhaps they would change their zero rate policy, which is where they've kept rates at zero while all other central banks have been raising their interest rates furiously. Anyway, it turns out that the new governor, when he comes in on the 8th of April, isn't going to change anything. Hence the reason why the yen has fallen quite sharply.
Absolutely. Okay, so that kind of brings us into the week ahead, Jerry, unless there's anything else to add. I mean, we've certainly got a few bits this week, three central banks announcing rates this week. So should we have a quick look through that?
Yeah, let's go for it.
Okay, so if I just bring us to the Forex Factory calendar, other calendars are available, of course, but we've got the coming week, we've got Australia, we've got Canada, we've got Japan, all with their central bank interest rate announcements this week. So take us through a little bit about that, Jerry.
Yeah, okay, well, the first one on Tuesday morning, we'll wake up on Tuesday morning, and of course it will all have happened. They deliberate in their afternoon. So the RBA, that stands for the Reserve Bank of Australia, and they meet like other central banks. We call it monthly, but most of these central banks have about 8 month monetary policy meetings per annum, and the RBA meets on Tuesday, which is very early in our Tuesday morning. We're expecting another hike in rates. You can see they're 3.6% from 3.35, so another quarter point hike in interest rates. They did start at 0.1, Adrian. That's the reason why they're not going in uniform rates like we are. But I think there's a 75% probability of a hike. So there's still a possibility that they may not do anything. But the minutes that were released of the last meeting suggested that they were likely to be raising rates again. But things are starting to just slow down a little bit in Australia as well. So it's not 100% certain. Aussie dollar will be very sensitive to this, of course.
Yeah, absolutely. So anyone holding Aussie dollar positions tonight needs to be thinking a little bit carefully about that, whether that's a sort of a bit of risk, especially if it's not so odds on. So what happens is that the market will price in the forecast. So if they do raise rates by 0.25% tonight, then you would kind of expect, if that was absolutely odds-on favourite, that the market probably wouldn't do that much. However, if it's only 75% certain, there's probably still scope for quite a bit of movement, even if it does raise rates. So we just got a little bit mindful of that, and then the slippage, the volatility that can come as a consequence, really.
Yeah, I think that sums it up pretty well, Adrian.
It's events like this that can create turning points, can create changes in direction in the market. So be mindful, please, everyone watching. Bank of Canada, 3 p.m. Wednesday, Jerry.
Yep, that's another one that meets this week, the second central bank this week. They're not going to be raising rates. The Bank of Canada keeps a close eye on its very, very close neighbor, the US, and with interest rates slowing down there, I think the Bank of Canada has made quite a few hikes in rates, currently at 4.5%. We're not expecting any hike in interest rates from Canada on Wednesday afternoon. I think that is more likely to be considered the next meeting following the Fed's deliberations.
So one point of note there for Trendsignal members, so for the D1 sniper strategy, I know that there's a potential trading opportunity on Canadian dollar against the Swiss franc this evening. So if we are taking that trade, just got to be a little bit careful ahead of those interest rates announcements at 3 p.m. on Wednesday. Again, safer play will be looked to perhaps reduce or close that trade ahead of that time. Bank of Japan, we've talked about that already. That's at some point Friday morning.
Yeah,
Jerry.
I mean, we talked about the change in governorship at the top there, but they're just not going to be doing anything with their monetary policy. They will not be changing interest rates, as you can see on the right-hand side, remaining at 0.1%. There is the interest rates that they're expecting, so that won't be changing at all.
And so for the uneducated amongst us, I include myself in that, what's the difference here? So you've got all these other economies around the world that are moving their rates up to sort of 3s and 4s. What's happening with Japan? Why is that still so low?
Okay, they've really struggled as an economy.
30-second version.
Well, they've made mistakes before, and they don't want to make the same mistake again. They have tightened rates too soon. And they basically, people talk about the lost decade, but they've effectively had lost 2 decades where there's been absolutely no growth. Certainly in the stock market, the Nikkei has not got anywhere near its all-time highs, and that was posted over 30 years ago. So they just don't want to be falling into the same trap. They know inflation's gone higher. I mean, the thing with Japan is that they can fund a lot of their economy themselves. They don't rely on overseas investors. So the exchange rate is the only thing that they have problems with. And of course, with a higher exchange, with a weaker yen, Adrian, the cost of buying in all of that oil and gas that they need has gone through the roof. Not only has oil and gas, well, it's gone up, it's come back down again now, of course, but it had been going a lot higher. And with a weakening yen at the same time, the cost in dollars was going through the roof. Oh, sorry, the cost in Japanese yen was going through the roof for Japan. But they're absolutely determined to stick with a 0 interest rate policy.
Yeah, well, time will tell. That's for sure.
Well,
then finally, sorry, Joe, we've got the non-farm payroll. That's non-farm employment change. It was a big number, big change last month. What do we think about this?
Well, what I think is that surely there's going to be some sort of adjustment, some sort of correction to that data, but you just never know. I think what is clear is that the employment market is incredibly tight, and for a central bank that investors were hoping would be looking to end their tightening cycle, I just don't think it's going to happen. It's 3.4%. That's record low unemployment rate.
Yeah. Yes, it's
Anyway,
quite remarkable, really.
yeah. Anyway, you can see the figure that we got last time: 517,000 jobs. We're expecting just under 200,000 this time last month. This time we're expecting 200,000 as well, 206,000 to be precise. That's new jobs created in the month of February. Just look out for those revisions in the previous one.
So how does that work? They post revisions for the prior 2 months, I think, isn't it? On
they can do, yeah. If they've got revisions, they sometimes revise even 3 months, Adrian. But obviously, the most important one is the previous one, which is in people's minds. So what tends to happen is they release the headline data first and then say what their revisions are. So the market immediately reacts to the headline and then suddenly thinks, well, hang on a second, gosh, they've revised the other one down, but I can't speculate on what it's going to be. All I know is, regardless of whether the previous number is downgraded, it depends on in the aggregate amount. So if we beat 206,000 by 100,000 and cut the previous one by 100,000, we're plus minus nothing.
Yeah, exactly.
I mean,
and that'll lead to quite a big reaction, won't it? I mean,
yeah, this is key. What you've got to remember is that the Federal Reserve they've got 2 mandates. Most central banks only have 1 mandate. The Federal Reserve have 2. The first being obviously maintaining price stability, but the second one is to foster full employment. My God, talk about full employment. You have to have some unemployment, like the US has got, for the jobs market to function effectively as people look for new jobs. But 3.4% is really, really tight. And the other thing the Fed will be looking at is the average earnings, because if that starts to tick up again, that can be inflationary as well.
Yeah.
And that's what it's all about, this, isn't it?
And that's also being released on Friday as well. So definite pencil sharpened for Friday. Again, if you're trading trading the markets at the moment, just have a little think about dollar-related positions coming into Friday lunchtime. So that will be, obviously dollar currencies, but also indices as well. So the S&Ps, the Dow, the Nasdaq, they're going to be sensitive to those moves. So again, risk-averse traders might want to think about reducing exposure, maybe closing some trades off coming into those numbers. Jerry, anything else we need to be mindful of, or are we pretty good?
No, that's it. There are other minor things happening with Jay Powell, the chairman of the Fed, testifying in Congress, but that's not so important. We mentioned the key ones.
Yeah, brilliant. Okay, Jerry, that's wonderful. Thank you for all those insights. That's excellent. What I'm going to do is take us through some charts now and have a look at our issue for the week, if you like. So we'll catch you later. Thanks very much, Jerry. Good. All right. So let's have a look at some charts. So as Jerry was talking about before, been some big moves over the last week or 3. There's some really great trades actually coming through. We can see some really good moves from the likes of was it Euro Yen. We had a lovely buy trade there a couple of days ago into last week, so 27th of February, giving us a buy, hitting target on that first day. Similarly, I think it was Aussie, no, not Aussie yen, one of the other yen pairs as well. Some really good moves. Indices are really interesting at the moment. As Jerry said, just be a little bit mindful of some of the size of the move. I'm probably going to do 2 sections together, because what we like to do in these is talk about what should we be trading, but also what's the problem, where we take a particular problem for the week, talk about it and think about how traders can try and solve that problem. So what I'm going to focus on today is correlation. And the reason for that is because the system, the D1 Cypher system here at Trendsignal, has identified a number of trading opportunities on the US indices. absolutely fine with these trades from a technical perspective. I'll have a look at those in just a second, but then we'll talk about how the correlation then works with that. So let me just bring those charts back in. Let's have a look at those indices. Now I'm going to start off with a trade from a couple of few days ago. So what you'll find with trades is that there is a correlation there. As Jerry talked about a risk on move earlier, we'll talk about how the indices can move in a similar way to the dollar and a similar way to some of the other other currencies as well. They can turn and rotate at a similar point of time. What we found with the yen was that gave us a buy trade here on the 1st of March, and that's fine. That it was an earlier trading opportunity compared to the other indices. You compare that to the Hang Seng. That's already hit target, by the way. It's a really nice trade. Hang Seng gave us a buy on the 2nd of March. We're already out of the Nikkei, taking profits on that one. It's about by risking 2% of your account on each trade. That was about a 3.5, 3.6% win. It was a really, really good reward to risk on that trade. The Hang Seng, just broadly sort of break even on that trade at the moment. That's okay. But we had quite a few trades on the 3rd. On the back of that sort of big move on Friday. Let's have a look through some of those. So we had the DAX, gave us a buy trade there. What do I like? What do I think about this particular trade? Well, as we go through it, we've got a buy opportunity from the close on Friday. It's break even at the moment on the trade. There's the stop loss here. What I think about it is that the market has hit a previous high. Let me just condense this chart up a little bit, just tighten it up so we can see a little bit more. So you've had some decent moves over the last few weeks. The market hit a high point of 15532. That's this dotted red line moving to the right. The market found resistance here, here, and you see how we burst above it. It's a bit like it's already broken through the ceiling. One of the things that we like about these markets is where there is sort of no obstacles between our entry point and our objective. Your resistance, especially when resistance has already been seen at a particular level, is something we need to be very, very mindful of. This particular trade, we burst through that resistance, meaning sort of free air there above. So really there's nothing to prevent it from going on towards its target zone. So pretty happy with that as a trade in its own right. Equally, when I look at the Nasdaq, that gave us a buy there on Friday as well. Interesting trade. Again, nothing really in our way until 12674. So that's about a 370 point move. That there's kind of free air in between. Again, if you're going to be jumping as high as you possibly can, but you've got a ceiling 6 inches above your head, you're going to get hurt, right? It's going to knock you down and knock you straight back down again. That isn't the case. The ceiling's way above our head heights, probably, I don't know, let's call it 12 foot above our head. I don't know about you, but I can't jump that high. So it's not something that's going to likely interfere with this trading opportunity. So that's a really good thing too. So we've got that nice, clean turning point from a market that is rotating in line with its weekly trend, in line with its longer term monthly trend as well. The momentum's pushing back higher again. This is what we call an old classic continuation trade. So the market's in a period of higher highs, higher lows. It's ratcheting its way higher. The longer term trends are up, and this is the next resumption of those longer term trends. So again, it's a nice, clean looking opportunity. Again, looking up to that sort of 12670 level. That's not to say that's where our target is. It's going to be inside of that, but it's a nice enough looking trade. Similarly, we'll look at the S&Ps, again, broadly unchanged, not a great deal of movement, next resistance level up at there. And in fact, this is the sort of thing that we're talking about. So when you look at a particular trade, there's a buy sniper there. The market hit that resistance level. We'd found resistance there the day before. We'd found resistance there. Number of times it can't break that 4160 level. That's a big ceiling in its way, okay? Every time the market's been getting up to that level, it's getting whacked back down. It's like an institutional seller is driving or selling its portfolio up at those levels. Fine. We don't really want to stand in the way of that. That gave us a buy trade right underneath that ceiling, that resistance level. It's a higher risk trade. Lovely short, driving prices down. That was nice and clean. Nothing in between there and its target. Similarly, this buy trade, nothing in between here and its target as well. So again, a nice, clean enough looking buying opportunity for the S&Ps. And then finally, we'll have a look at the Dow as well, which is in a similar sort of picture. So again, technically, a nice enough looking opportunity. The monthly trend is positive. You can see the Trendsignal oversold, the Trendsignal line below that 25 zone, which means a lot of the sellers have been driven out of it. They've sold out already. If everyone's already sold, what are you left with? You're left with potential buyers who can then drive the market back up from a deep position. So again, in line with that monthly trend direction too. So what do I think about these? At the moment, that means that we've got 5 index trades on at the moment, which you could say, my God, let's go for it. But actually, from a risk perspective, let's think about that in what that actually means to us. Now, if you're going to risk, say, 1% of your account on each trade, you've got to think about correlation. So the problem a lot of traders sometimes face is correlation and then what to do with it. So if you're risking 1%, effectively that's 5% at risk across those 5 trades. If you're risking 2% of your account on each trade, effectively that'll be the same as risking 10% of your account in total across those 5 trades. So in itself, having multiple positions open isn't really a problem. I don't have much concern over it really. But I do when it's all the indices, because with the indices, they're all going to have a very similar fate. They're likely to be probably 4 out of 5 are gonna, or 5 out of 5 are likely to be either winners or losers depending on this particular turn. What that basically means is that their account could be at 10% risk. That's quite a lot over one particular move. So what's my view on this? If you're seeing correlation in your portfolio, in your set of positions, what might you want to do? Just adjust your risk accordingly. Be mindful of it. Remember, the goal here with trading is to be making or edging towards our weekly, monthly, annual profit goal. Okay, it's not about all or nothing. We don't want this emotional roller coaster with our trading. Ideally, we'd be looking to smooth things out. Again, I like sort of sporting analogies. If you're going to think about that sort of route, maybe golf. This is a little bit like, going onto a hole that's got water, it's got bunkers, it's got out of bounds down both sides. It's a bit risky. Yes, you could go and smash a driver up there, but actually the safer play will be to take an iron, put it down in somewhere towards the middle of the fairway and just go for a safer 4 or 5. Do you see what I mean? It's about trying to reduce risk and manage it accordingly. Because if the market doesn't go up and it goes off a little bit, our portfolio can be managed and it's all down to maintaining our risk. Because otherwise we've got to make 10% back, whereas actually I'll be much happier making 4 or 5% back. Okay, again, hopefully that makes a little bit of sense. So what could we do? Couple of things as a trader. Number one, if you've got 4 or 5 trades that are setting up, you've got quite a bit of correlation on, think about reducing your trade size across the board. Think about maybe only taking 1 or 2 or perhaps 3 of those positions instead. Just use perhaps a common sense approach rather than just loading up all in. And that's across all strategies, by the way. This is not really something that I'm thinking specifically about Trendsignal traders. Anybody who's trading the markets, think about that degree of concentration. If you have your own investment portfolio, okay, regardless of what's happening in the markets, if you've got your own stock portfolio and you've got predominantly UK stocks, which is fine, by the way, I've got no problem with that. Are they all in mining stocks? Are they all in utility stocks? Are they all in stocks which are, I don't know, oil stocks? Think about the sectors, spread them out a little bit. There is a natural thing where you're going to look at perhaps dividend yields. Some of those resource stocks like the Rio Tintos of this world, hugely high yields at the moment, but dividend yields. But if you are loading up too much in those, you're going to be very exposed to a pullback in the economy. So just think about spreading that risk across different sectors in your portfolio. Similarly, it's common sense, right? It makes sense. You can spread it across utilities, household goods, various other things that you can spread across and have a broader spectrum of stocks in your portfolio. Similarly, when it comes to trading, I'm not saying that you have to then trade all sorts of different markets. What I'm saying is think about that correlation in a slightly different way, and you could reduce your trade size down accordingly. These are good looking trades, but just be mindful from a risk perspective. The way I kind of liken it to look is really, we're not traders, we're really risk managers. The better we can manage risk, the more the profits will look after themselves. Okay, so that's pretty much it from me. So thanks very much for watching and listening to today's vodcast. Hopefully that's been useful. We're going to be doing these each Monday, so do please tune in to your favorite social media websites and also to our own website, which is trend-signal.com. Hopefully some more interesting insights. All the best, everybody, and we wish you all your success with your trading for the week ahead. Bye-bye for now.